Chair. My name is Wilson Kajrenji. I represent Nyabushozi constituency in Chiruhura district. I'm also chairperson of Defense and Internal Affairs Committee and chairing this joint committee. Honorable Governor and your team, I'll give you a chance. You introduce your team and you make a presentation. For that, we are giving opportunity to all Ugandans, all stakeholders. This morning we had an opportunity that has not been the case before. We had a 1 hour presentation from Ugandans in the diaspora on Zoom, giving us their views from different countries and statistics of what they collected on each and every clause. The 11th Parliament has given opportunity to Ugandans to voice out their concerns pertaining to this bill. This is a 4th-day marathon, non-stop, day to evening. And we thought that it is pertinent that we listen to Bank of Uganda because of its constitutional mandate and dealing particularly with the proposals as contained in this bill. The second presentation related to yours will be from Financial Intelligence Authority. But first, we give you a chance, introduce yourself and the team, because we have no time, make your presentation, then we go to Financial Intelligence Authority. You're most welcome to the 11th Parliament, to the Joint Committee, Defense and Internal Affairs and Legal and Parliamentary Affairs. Over to you.
Okay, thank you, Chairman of the Joint Committees and the members of the two Joint Committees. My name is Michael Atingiego. I'm the Governor Bank of Uganda. To my immediate right is the Deputy Governor, Professor Augustus Nwagaba. And to my most immediate left is Dr. Twine, who is the Executive Director, National Payment System. Next to him is Dorothy Ochola, who is our Acting General Counsel, followed by Huntington Waswa, who is the Acting Executive Director of Supervision. And behind we have Loy Nancha and Eric Mogarura. Chair, first of all, I want to thank you for giving us this opportunity to come and share with you our thoughts on the protection of the Sovereignty Bill 2026. And we are basing our presentation on the letter that you invited us here, where you asked us to review the bill's provisions, its interaction with the existing frameworks, and the anticipated legal, economic, social, and diplomatic implications. So here we are presenting this bill, knowing that Bank of Uganda, in the fulfillment of its constitutional mandate as the primary steward of monetary and financial stability, we are submitting this technical assessment regarding the protection of the Sovereignty Bill 2026. Chairman, allow me by quoting Article 189 of the Constitution of the Republic of Uganda, which prescribes that the function and the services of that are specified in the 6th schedule of the Constitution, including banks, banking, promissory notes, currency and exchange controls, shall be the responsibility of government. And Para 3 of the 6th schedule explicitly reserves these functions for the government, while Para 11 and 12 address the foreign relations and external trade. Now, compare that with Article 162 of the Constitution of the Republic of Uganda, which, when read together with Section 4 of the Bank of Uganda Act, Chapter 54, and Section 143 of the Financial Institutions Act 2004, the government of Uganda, by establishing the central bank as a statutory body, has delegated its functions under the Constitution to the central bank and given it the constitutional and regulatory primacy over all matters concerning the formulation and implementation of monetary policy directed to economic objectives of achieving and maintaining economic stability for the Republic of Uganda and on behalf of the government of Uganda. Now, Article 162, subsection 2 of the Constitution clearly protects the Bank of Uganda from being subject 2, direction or control of any person or authority in performing its functions. Therefore, any legislative or administrative action that introduces parallel oversight or restricts the operational independence of the Bank of Uganda risks contravening these constitutional provisions and undermining the legal and institutional framework for the financial sector governance. And Chair, in addition, with respect to matters concerning financial institutions, the Financial Institutions Act takes precedence over any enactment, and in case of conflict, it shall prevail. So that's the basis on which we are going to make our technical assessment. Now, we also note that for the avoidance of any doubt, Bank of Uganda is established to protect the national sovereignty from foreign interference as enshrined in section in Part 4 of the Bank of Uganda Act. And here I was saying, however, while protecting that national sovereignty is a paramount constitutional objective, the financial system's technical architecture must remain shielded from regulatory fragmentation. This assessment argues that the bill in its current form risks introducing regulatory fragmentation and subjecting this economy to voluntary shocks, potentially undermining the very economic strength upon which true national sovereignty is built. Now, Chair, let me look at the technical review of the legislative provision and the regulatory alignment. Here, I'm going to look at what are the core principles and the key provisions that we are going to address. Now, the bill designates the Department of Peace and Security in the Ministry of Internal Affairs as the central regulator for agents of foreigners. Its primary technical mechanisms include, in Clause 1, expansive definition, where an agent of a foreigner is defined, and then it also introduces the cabinet gatekeeping under Clause 6, which prohibits any agents of a foreigner from performing the functions or the services for which government is responsible. And then the other one is to do with the mandatory registration, which is in clause number 14, that requires entities to register with the Ministry of Internal Affairs and obtain a certificate valid for 2 years. And then there is another clause, 22, which is foreign funding restrictions, that imposes a cap of 400 million shillings, that is 20,000 currency points. And then the other clause 23, subsection 3, the vicarious liabilities, the penalties. And then clause number 25, the enforcement via financial institutions, which prohibits banks from paying out funds to foreign agents without verifying ministerial authorization, and the civil penalty of 4 billion Uganda shillings for non-compliance. And then, Chairman, the one that concerns us is economic sabotage, which is clause number 13, which criminalizes the publication of information that weakens or damages the economic system and is punishable by up to 20 years in prison. So, we are now going to go through clause by clause technical assessment. Here we are noting the key conflicts between the bill's provisions and the existing financial regulatory framework as highlighted in the table below. So we cite the clause, the key issue, the conflict, and our recommendation for refinement. The first one is defining what an agent of a foreigner is. The key issue is that this bill has broadly defined it, it captures even own fintechs, Uganda'S abroad, and then the conflict with the existing framework is that it overlaps with the Bank of Uganda prudential supervision under the Financial Institutions Act 2004. So what are we recommending as a refinement? We think that we should exempt supervised financial institutions licensed by Bank of Uganda, Capital Markets Authority, or development finance institutions from this provision. And then the registration requirement, the dual licensing of SFIs where they say that SFIs must register with the Ministry of Internal Affairs. We think that this is creating regulatory arbitrage. So we are proposing as a refinement, we carve out a carve out for the supervised financial institutions, licensed and supervised by Bank of Uganda. And then clause number 16, the suitability inquiries. And here, the provision of mental, fiscal, and health checks for directors. That's what is in the bill. We think that it does exceed Bank of Uganda's fit and proper standards, which may deter qualified professionals. So we want to align it to Bank of Uganda's framework and or remove the health inquiries. Now, the rest, in the interest of time, can be read. But let me now look at the interaction and conflicts with existing frameworks, the parallel regulatory regime that overlaps with the established mandates, creating dual licensing. The first one is constitutional. Article 162 of the Constitution, which mandates Bank of Uganda to promote development and maintain independence. Now, if you interact with the bill introduces ministerial oversight that conflicts with the Bank of Uganda's exclusive mandate. And then the Financial Institutions Act 2004, the prudential supervision of fit and proper vetting. Clause number 14 creates a dual licensing. It also introduces overlapping suitability in clause number 16. And in the National Payment Systems Act 2020, the oversight of cross-border transfers and payment providers is a core function and mandate of the central bank. But what this bill is now proposing that under clause 25, it imposes gatekeeping duties and a 4 billion civil penalty on the providers. And then the Anti-Money Laundering Act, the source of funds and violations reporting are all covered under the Financial Intelligence Authority. But clause number 21 creates a parallel reporting channel, public inspection of declaration, which violates the banking secrecy. And then the other one is to do with the Political Parties and Organizations Act, which restricts contribution from foreign sources to political parties to 20,000 currency points within the period of 12 months. And so it also prohibits political parties from demanding equivalent of 200,000 currency points. So we are seeing that the interaction with the proposed bill is that Section 13 has similar restrictions as introduced in the proposed bill, which are only limited to political parties. Now, Chair, let me go to the most important aspect of our presentation. That is, what are the comprehensive assessments of this bill? Chairman, let me be very clear from the outset. This bill is about cross-border payments. And cross-border payments is about the balance of payments, because the balance of payments is a comprehensive record of all economic transactions between a country's residents and the rest of the world over a given period of time. It tracks the inflows and outflows of money from trade in goods, services, and financial assets. The balance of payments is divided into current account balance and the financial account, and of course the capital account. Now, what is the case of Uganda? The case of Uganda is that the current account balance has always been in the negative because our imports are far much greater than exports. So how do we close this? It's through financial flows. Financial flows into the financial account. And where these financial flows exceed the deficit in the current account, that's how we build reserves. Now, what is this bill doing? This bill is bringing restrictions into cross-border transactions, meaning that it is bringing restrictions on the inflows to this country. And we run a risk of reducing substantially the inflows into Uganda. And if we reduce these inflows into Uganda, it means that our current account is even going to widen. And with the restrictions, there will be limited inflows in the financial account, which is going to make it very difficult for us to finance the widening current account balance. So how then does the balance of payments balance? We are going to have a substantial depreciation of the currency because you need to make imports more expensive in order to equate imports to exports. So this is the main risk of this bill. And also, it means that our capacity to build reserves, because now the flows in the financial account are reducing, we won't have any excess of financial flows in the financial account over the current account balance to build reserves. And Chairman, a country without reserves is not sovereign. So, the most important thing is how do we deal with this? If you look at, for example, what is being proposed, the potential of this bill to destabilize Uganda's balance of payments is our primary concern as a central bank because it affects cross-border flows. For example, last financial year, the overall balance of payment surplus was 1.5 billion, meaning that the financial inflows in the financial account were in excess of the deficit in the current account balance by 1.5 billion. And that's how we were able to increase our reserve coverage by 1.5. Today, as we talk, our reserves are close to $6 billion. Why? Because these inflows have been coming in. The moment you tamper with these inflows here, we risk running down our reserves. And that is economic disaster for a country. So, these inflows were driven by foreign direct investment of 3.4 billion, portfolio investments of 2.1 billion. Remittances, we are now requiring that remittances, if there's a Ugandan in the diaspora, he's a foreigner, by the definition of this bill, and anybody who receives these remittances in excess of 400 million is an agent of a foreigner. He has to be registered by the Minister of Internal Affairs. Honorable members of Parliament, for remittances that are sustaining the livelihoods of Ugandans, we are likely to see even a reduction in the remittances. I don't know what the diaspora people told you, but this is likely to come down. Last year, we got remittances of 1.5 billion. And so it means that we are going to have pressure on our currency. And then the most striking thing also is, if you look at our securities market, government of Uganda is undertaking significant borrowing to finance its budget. And if you look at the holding of government of Uganda securities by non-residents, by these foreigners, they are holding to close to about $3 billion, which is about 12% of the securities that have been issued are held by this. And going by the definition in this bill, where ministerial approval for the threshold is acting as a capital control, experience in other jurisdictions shows that it leads to immediate exit of the offshore investors. And when they exit, it means that we cannot fully finance our deficit through borrowing. And if we are going to finance, it's going to be through very high interest rates. And as they exit, it will have impact on our currency. And then the other issue is clause number 13 about economic sabotage, that at the publication or anything that causes the weakening of a system is qualified as economic sabotage. Now, Uganda's debt servicing is currently about 50% of government revenue. By criminalizing economic research that identifies fiscal instability, as in clause number 13, the bill destroys what we call price discovery. Because if I'm an investor, I need to look at all the information about an economy, then I price based on that information. So when I don't have that information, because we don't have, the bill has said don't publish anything that weakens the system. what do I do if I'm an investor? I'm going to put what I call uncertainty premium, all right? So that if I had discounted for the fiscal instability or because of the high fiscal deficit into my pricing initially, now I don't have that information. I'm going to put uncertainty premium. So if I was bidding for a 25-year bond at 17%, I'm going to end up bidding at 20%, just in case I've got it wrong. Why? Because I don't have information. Markets rely on information, a wide array of information to do their pricing. So clause number 13 in our view is going to distort price discovery. And then also, when we publish a report about maybe inflation is projected to rise or the currency may depreciate, so we need to tighten monetary policy to do that. Now, if tightening of monetary policy leads to lower credit growth and the economy weakens, will I be charged with economic sabotage? Then the other issue is financial sector, de-risking and operational paralysis. The banking industry faces a systemic threat from financial de-risking and regulatory overlap. The corresponding banking that facilitates trade and clearing transactions. These banks operate on a zero failure compliance environment. If routine operations like capital injections or trade financing clearing require ministerial approval, international banks are likely to terminate relationships, therefore isolating Uganda from the global payment system. And then the recruitment deterrent. Clause number 23, subsection 3, with its liabilities, and clause number 16 of intrusive suitability inquiries, including fiscal health, may deter qualified professionals from participating in the governance of the Ugandan financial institutions. Colleagues, honorable members of parliament, I want to be very frank here. When we are looking for board of directors for financial institutions, this is a skill that is still very scarce in Uganda. Now, most of these financial institutions have ended up getting skills from abroad into their governance structures. Now, with these very, very intrusive suitability requirements, it will be difficult for these supervising institutions to get these skills, and therefore we are likely to end up with weak governance in the financial institution. And then procedural disruptions. There's a lack of the commencement clause. So when this bill, if passed, when does it become operational? There's no transition time given, but that's another matter. And then in terms of the capital requirements, you all know that Tier 1 banks require 150 billion, Tier 2 require 10 billion, Tier 3, 4 require 1.5. Now, this cap would severely restrict capital injections, intercompany shareholding loans, and correspondent banking, all of which are essential for liquidity management and regulatory compliance. And then the policy framework, and this is, honorable members of parliament, this is a very, very important point. Since 1990s, the Uganda's successful and sustained economic recovery has been built on policy predictability. What this bill is introducing, it is introducing what we call time and policy inconsistency. That is going to threaten the tenfold growth that the government of Uganda is aspiring. If you look at our investment levels that are required, they are far much lower than the savings we have. So we require foreign capital to fill up this gap. Now, if we are going to grow the economy to $500 million by 2040, we require annual FDI to rise to about $50 billion. And we require domestic savings to strike to 40% of GDP. Now, the administrative restrictions that this bill is creating is not going to make this possible. So what happens to our tenfold growth? Because this is going to slow it all down. So we need to look at how is it affecting other policy objectives. And then because the bill is so restrictive in regulation, is likely to drive actors into informality. We are going to have informal channels again coming back. Things like the Hawala systems or the unregulated financial instruments, which is eroding the tax base and undermining the bill-stated goal of transparency. Honorable Members of Parliament, it was only in 2024 that Uganda came out of the Financial Action Task Force grey list. Why? Transparency was one of the key issues. So we are trying here to increase transparency as much as possible. Now, if the bill is going to create informality and therefore raising transparency, what are the chances that we might get back into this? It's something for each of us to ask ourselves. And then contract frustration and legal uncertainty. Financial institutions by their very nature deal with multi-year loans, multi-year transactions. So if the bill is, if the agent of a foreigner requires to be renewed after every 2 years, and the bank here is an agent of a foreigner, you have this multi-year loans that you have gone into. Suppose, God forbid, the Minister of Internal Affairs doesn't renew the license for you being an agent of a foreigner. What happens to your multi-year contracts? So I think there are certain challenges in there. So this risks sovereign borrowing disruptions, breach of contracts lawsuits, loss of investor confidence due to restrictive application, and what have you. Also, Honorable Members of Parliament, we are now in a digital economy where real-time transactions take place. Now, we require the Minister of Internal Affairs to approve any payments that are going to be made by agents of foreigners to foreigners. In a real-time payment, straight through processing, at what point does the Minister of Internal Affairs come in? When we have digital. Unless we're going to say that let's stop digital and go back to manual.